Hello, everybody. Thank you for attending the Properties first webinar of 2024. I'm Alex.
And
this is Andrew.
I'm Andrew, the Managing Director of the Property Factory. So hi to everyone tonight.
And full disclosure, we both share the same last name. It's Wilson. We're not related. We're not brothers. He's not my father or vice versa.
Fair brother, but
yeah.
you know.
I think that's going to become a bit of a tradition for our webinars, Andrew. We have to get that bit out of the way first.
Yep.
But yeah, thank you all for being here. We obviously promised for those of you that were at our last webinar in December of 2023 that we would do a webinar every month of this year. Now, I think we actually said we'd start in February. It's January.
Yeah,
admittedly, it is the last day of January, but yeah, I think that's positive. So every month we'll be running a webinar. Obviously, every month will be a different topic. We'd love to hear your thoughts on topics we should be doing as they become relevant throughout the year. So if you have any topic ideas, please flick us a message on Instagram, flick our website a message, and you know, they might end up being one of the actual webinars throughout the year. So today we're going to be talking about, I'm sure you've all seen the topic, but today we're going to be talking about how to pick the right investment properties. So we're going to discuss some of the characteristics of a good deal, as well as some of the characteristics of a bad deal. Anything to add there, Andrew?
Not really. I guess we'll just discuss as well what the Property Factory does to work out, you know, whether it's a good or a bad deal and whether it's good enough to end up on our websites. We'll talk a bit about that and how we go about selecting these properties and making sure that they're, you know, a good deal in the marketplace for investors and first home buyers.
Yep. Just in relation to questions, please, if you've got any questions throughout the webinar, do send them through. We may answer them as we go, but most likely we'll just leave all of the questions until the end, and then we'll go through them at the end, because you might find that your question is answered as we go through. But if it is super relevant to the topic that we are discussing at any given point, then certainly we might go ahead and answer it, but we will answer all questions at the end. So give me a second. I'll just share my screen and we will get into it. Okay, perfect. So as I said, the topic for tonight is how to pick the right investment property. For those of you that were at our webinar towards the end of last year, in December, the theme or the topic for that webinar was what we had seen in the property market throughout both 2022 and 2023, and then what we expect to see into 2024. There's certainly been a lot more activity in the market since then. Is that a fair assumption, Andrew?
Yeah, I would say so. We've seen more activity in the last month or so, or the last few weeks of this year since we've been back, since probably all of last year at least. So there's definitely a lot more activity out there, especially with investors and experienced investors. So there are people out there that realize that now is the right time to get into the market, and obviously getting a good deal is the key. So, yeah.
Yeah, I guess the reason we decided to talk about how to choose the right investment property tonight is I guess it's a timely topic considering it's the start of the year. And also, as Andrew and I said, there are a lot of investors and home buyers looking to enter the market now. And so it is really important as you start looking out there in the marketplace to know how to determine a good deal from a bad one, because there are a whole lot of listings on the market. Doesn't necessarily mean they're all great deals, doesn't necessarily mean they're bad either, but there are also a lot of average ones. So the more you know, the easier it is to make a good investment or make a smart decision. In terms of what we'll be covering tonight, we'll briefly touch on who the Property Factory is and what we actually do. Now, I know we spoke about that briefly last time as well, but for those of you, that are new to our webinars, we'll just introduce ourselves and talk a little bit about what we do and how we are different to both developers and other real estate agencies out there. Obviously, we'll talk about some of the characteristics of a good deal as well as a bad one. And then at the end, we'll do a Q&A session. So as I said, we'll answer most of the questions towards the end of the session. So as Andrew said earlier, he is the Managing Director of the Property Factory. Andrew, if you want to give us a little bit of a rundown in terms of what we actually do, that would be wonderful.
Yeah, sure. So at the Property Factory, we're a real estate agency and we specialise in off-plan and new build property. And basically what we do is we deal with a heap of different developers around the country, probably over 50, and we look at a whole lot of different deals, at least a few a week. And basically what we do is run the numbers, look at a whole lot of different factors that we'll talk about tonight, and work out which of these deals are the best deals. And these deals end up on our website pretty much. I think it is important when buying off the plan that you know what you're doing, or work with someone that does know what they're doing, because it is a bit different to buying a house down the street. When you're buying off the plan, obviously the sale and purchase agreements are quite different. There's a lot of vendor conditions in there that you need to be aware of, and there's quite a few different factors at play. If you get it right, I think you can do much better buying off the plan than you can buying secondhand properties, but you just need to work with someone that knows what they're doing, basically. As you can see here on the slide, we do a lot of due diligence on the developer themselves. We look at their track record. We look at, obviously, what they've built in the past. We look at the project itself. Is the project actually financially viable? We look at, developers' situation. How well capitalized are they? Do we think it'll actually get built? And a whole lot of different factors. So we do that at the Property Factory. Obviously, a developer wouldn't do that on themselves, and generally a real estate agent that's listing that on Trade Me only generally wouldn't do that. We're obviously off the plan specialists. As I said, we know what we're doing with regards to the process, which is a bit different to buying standard real estate. We pre-negotiate pricing with developers often. We know who's offering deals, who isn't, whether it's a good deal in the marketplace. Often we help developers set pricing as well. We've got investment knowledge, obviously. Talk to our sales team. They've all got good investment knowledge, and they know which properties to select for yourself. I think Alex will talk a little bit about our investment capacity report, and that report really helps us pick the right property for someone, because when you're getting into property investment, it's really important to start right and get the right property right from the start. And we provide settlement support as well. So basically, when you buy a property off the plan, generally you'll put a 10% deposit down when you go unconditional on the property, and then it may be a year before that property's actually completed. And during that time, we provide regular updates through our support staff, so you know where the process is as you're going along. And when it comes to settlement, we help you with the pre-settlement inspection. Just make sure everything is running smoothly right through to settlement, so you've got someone looking after you the whole way. And generally that wouldn't happen if you're buying off a standard real estate agent. So yeah, we provide that service for our clients, and just to make sure the process runs smoothly. And as I said, if you do it right, we believe it's the best way to buy investment property.
Mm-hmm. For sure. So obviously, when it comes to spotting a good deal, it is really important to do your research. Now, at the Property Factory, we like to think that we take most of the headache out of purchasing an investment property for investors. So we have a range of tools we use essentially to assess whether a property makes sense as an investment or whether it doesn't. And we also have a number of tools that we use to work out which properties are right for you and your financial circumstances. So one of the tools we have developed is a tool by the name of the Investment Capacity Report. Now, it's super cool. You can request one through our website. It literally takes 30 seconds to fill out the form. It asks you a few questions in relation to your financial situation or circumstances. And then what it does is it essentially assesses what your strengths are in relation to your personal balance sheet, as well as what your weaknesses are. So it looks at things like your income, the value of your existing properties, any debt on those properties. And as I said, it basically assesses your strengths and weaknesses in relation to your personal balance sheet. So off the back of that, it will actually recommend properties too that are best suited to you and your financial circumstances. And then our investment sales specialists can actually use that investment capacity report to, again, go through some of the properties we have on our stock list and essentially work out which ones are right for you and your circumstances. We also run a whole lot of cash flows and growth forecasts on all of the properties we list, at least the properties that are on our website. It is important to note that the properties on our website are really just the tip of the iceberg in terms of what we actually have listed. So if you are on our website and you're scouring through it prior to speaking to one of our investment sales specialists, just note that we do have access to a lot more properties to sell than what you can see there. So don't be deterred if you don't quite find the right property for you on our website. There are a whole lot of other options. It's just a case of getting in touch with us. And then one of our team can run cash flows and growth forecasts on really any property that you might be interested off the back of your initial conversation with them. Obviously, we do investment analysis, and that ties in with the investment capacity report and the cash flows and the growth forecasts as well. In terms of inside information on developments, like often we know what is happening with a particular development, where it's at, how keen the developer is to get sales in there, and therefore what sort of discounts they're willing to look at. So I guess by working with the Property Factory, as opposed to just scouring Trade Me or looking on realestate.co.nz, you can get insider information in relation to, what developers are willing to accept, deals they're looking to do, as well as really just what makes sense and what doesn't. So yeah, that's a little bit about some of the resources we offer and ultimately what we actually do. A little bit about our track record. Andrew, you might like to touch on this briefly.
Yes, we've sold roughly, whether it be 500-600 odd properties. And since we've been in business, we work with a lot of different developers, as I said already, and we've had none of our developments have failed to complete. So I think we're pretty proud of that as a business. Sometimes, projects can drag out for different reasons. It can be anything from supply chain issues to councils and trying to get titles and a whole lot of different things. But, generally, I'd like to think we've done our due diligence pretty well, considering we've sold that many properties to, first-time buyers and investors and some other homeowners, and everything's got completed. So yeah, if you work with us, you can at least you're going to get something that's going to be completed. And otherwise what can happen is you might put a deposit down on a development, it might look great, and some of the conditions in the agreement, one of them might be the vendor's financial viability of the project or something like that. And what might happen is you put your deposit down, they work out in 6 months' time it's not financially viable, never gets built, you get your deposit back, but it's that opportunity cost of that 6 months of missing out, especially in a rising market. So I think it's it's a really good thing about our business anyway, that we haven't had any projects fail to complete.
Yeah, just on that side of things, a lot of investors do worry about a development taking longer than expected to complete. And realistically, that is something that can happen when purchasing off the plan. But in my opinion, and I'm not sure whether you agree, Andrew, at the moment, the further out a development is from completing, i.e., the further out a development is from completing, the better, because obviously the market has essentially reached its bottom and is beginning to rise again. At least that's what all the economists and analysts out there are saying. But interest rates are still relatively high, certainly much higher than they were a couple of years ago. So if you're to purchase now, you can lock in today's price, which is obviously the bottom of the market, and settle in, say, 2 years' time, and at which point hopefully interest rates will be at least 1 or 2%, maybe 3% lower than what they are today. So you really get the best of both worlds, in the sense you lock in a low price and then hopefully pay a lower interest rate in 2 years' time when you go to settle the property than you would if you were to settle the property in, say, 2 weeks' time. And that would be the case if you were to purchase an existing property, for example.
I think so, definitely at the moment, as Alex said. And we can see from CoreLogic that prices went up about 1% in December, and probably we'll see something similar in January. And if that carries on for the rest of the year, that's about 12% over a year. So we're definitely seeing prices starting to rise. So as Alex said, if a project is some distance away, there's plenty of upside, and, rents are going up, as we know, and prices are going up. So you should have some good equity on settlement, and you should have a better cash flow situation than you would if you settled it today.
Yep. Okay, so let's get into the sorry for the lag there, just a quick technical difficulty. We've fortunately got our IT guy sitting here, so if anything does go wrong, we're in safe hands.
Major anyway.
Because Andrew and I don't know the first thing about computers or technology. But anyway, right, on to the topic, how to pick the right investment property. So there are a few factors we generally look at when assessing whether or not a deal makes sense or it doesn't. And probably at the moment, and these factors can vary depending on the market conditions, but probably at the moment, the main factors we'd be looking at, or components to a good deal we look at are the pricing. We'd look at sort of the rental yield and where that sits. We'd look at some vendor incentives, whether there is a vendor incentive, whether it's a good incentive or whether it's not, as well as gentrification of the area. So essentially infrastructure improvements and future growth opportunities. And I guess one of the biggest components of property investment that ties into gentrification and just general growth is capital growth, i.e. The amount your property goes up over a certain time period. So what we'll do is they're sort of the main topics we'll cover in this webinar, and we'll just break them down piece by piece and talk about them in a little bit more detail. But that's essentially the gist of what we're going to cover in terms of how do you actually spot a good deal out there in the market. So the first thing we'll look at this evening is price. Now, obviously, when purchasing an investment property, the last thing you want to do is overpay for a property. I mean, in the words of Warren Buffett, price is what you pay, value is what you get. You could pay $800,000 for a property, for example, and you may think that that's a good price. But if nobody else out there in the marketplace thinks that that is a good price and isn't willing to pay for that now, or at least in the near future, then the price you paid probably isn't a great price for the property. Is that a fair assumption, Andrew?
Yeah, that's right. Exactly. Yeah.
I mean, there is the odd anomaly out there. Some people are just really good at spotting good deals before everybody else, I guess, knows that it's a good deal. But yeah, price is what you pay, value is what you get. So when purchasing an investment property, it is really important to scour the market, see what else is out there, and to really look into how the property you're looking at stacks up in relation to other properties on the market. So there's a number of different ways you can do that. The first really is to, as I said, make sure that the property is competitively priced, i.e. the purchase price is at least on par, if not lower, than similar properties in the area. The second thing you can do is request a valuation, and at the Property Factory, prior to listing a development or a property, we will actually get a valuation done by a registered valuer, or the developer will get one done. And a number of the deals on our stock lists are actually priced below valuation. So there is some equity there in the sense if you're purchasing below valuation. But I guess there are a number of tools and means you can go to ensure that a deal you're looking at is actually a good deal. I think the biggest one is to look at past sales, look at other properties on the market, and really just figure out, hey, is the price I'm paying less than that of similar properties on the market?
Yeah, and I think even looking at what's listed on the market, and then is that selling as well? So there might be something listed at a similar price, but that hasn't shifted. So then maybe it is a bit expensive, even if it's on par with that. So we look at a number of factors when looking at pricing and how it compares to other properties in the market.
Yeah, yep, for sure.
Also, often with developments, there can be good and bad deals in the development as well. Like sometimes a developer might list a project, or a real estate agency might list a project, and they might say from 599 or whatever it is, and that sounds great, but
this
it might
is on Trade Me, right?
This is on Trade Me, yeah. This is on Trade Me. Sorry, so they might say from 599, but there might only be one unit from 599. It's the smallest one, doesn't have a car park, and etc. So also looking at this slide, there can be good and bad deals in the same development. So it's a matter of breaking down the developments piece by piece a bit as well. You can see from this example, you got a 3-bed unit in this particular development from 749, which is a very good price for a 3-bed unit in this area, we had sold other units for 100,000 more than that. Whereas if you look at the 2-bed units, they're not so, it's not a whole lot cheaper than a 3-bed unit.
This is a suburb in Christchurch.
This is a suburb in Christchurch.
Yeah.
This is a real example. So yeah, when you look at that, obviously the developer in this case is looking to make a bit more margin on the 2-bed and a bit less margin on the 3-beds. Whereas if you look at some other developments around, a lot of developers will sell the 2-beds off relatively cheaply to make their pre-sales, which I'll talk about a bit more in the next slide. But then the 3-beds could be another 300,000 more expensive. So it's a matter of looking at each development and what's good value in that development as well. So a few different factors to consider. Also, when buying off the plan, you need to look at, to get the best price, or whatever your situation is, you need to look at when the best price to buy is during the process. Often developers, for a start, most developers require finance to do to complete their projects. And basically the financier will have a certain amount of pre-sales that the developer needs to make prior to them starting the development or getting their funding. So often a developer might say you had 40 units in a development, the developer might sell 10 off cheap because they might need 10 to get pre-sales. So if you want to get a cheap price, the best time to get it is right at the start when they're keen to get sales. But then there might be other situations. So you might have a low deposit, so you might only have a 5% deposit, and you don't want to outlay a lot of money. Generally, a developer would need a 10% deposit to count that as a sale for finance. But once they reach that threshold, then potentially, in some cases, they might take a 5% deposit, and then so you might be able to secure a property, maybe not quite as cheap, but if you don't have as much money to outlay at the start, you could always buy something a bit later on, less deposit, but the price is a bit higher. So it depends on your situation a little bit as well. But yeah, it's really a matter of knowing, and I guess talking to someone that knows the process, knows the developers, just to realize exactly when to buy to get the right price, or to achieve what you want to achieve. Another example might be, sometimes at the end of a development, developers might hold some units back and try and get a premium for them. But in other cases, they might need to, often the profit will be tied up in the last few units, and they might need to sell the last couple. They might be keen to clear them to move on to the next development. So, and you might get a good deal there as well. So there's different ways to get a good deal in different developments. It's just a matter of knowing, I guess, what's going on within that development, and then then you can, I guess, work out how to get the best deal. And that's why you should deal with a company like ours who understands that. Yeah,
we do really know where, any developer we're working with, we really do know where exactly they sit in relation to that sales and development process. Whereas if you're just scouring on Trade Me and getting in touch with the developer directly, it is incredibly hard to distinguish where they actually are in that process. Because as Andrew said, every investor and every purchaser has different preferences in relation to what they're looking to achieve. Get in early, get a good price, or get in a bit later and potentially secure a slightly lower deposit. We know exactly where the developer is in relation to that process. So it is one of the real benefits that comes with getting in touch with a company like the Property Factory.
Yeah. And even, so there's one more thing to note there. Sometimes developers have private funding, or they don't require finance. And in that case, you might be able to get in early and get a lower deposit. So it's just a matter of knowing the situation with each developer and what they're willing to accept.
For sure.
Yeah.
Just going back to this slide, the amount of times I see on Trade Me, and we get buyers send it to us all the time, a 3-bedroom unit within a development advertised for the price of a 2-bedroom, just to rope inquiry through the door is ridiculous. It happens all the time. So if a price seems too good to be true on Trade Me, it likely is. It's probably the price of a 2-bedroom unit if you're looking at a 3-bedroom unit. Just a warning there. It's actually almost false advertising, to be fair. Another important thing to look at when it comes to assessing a good deal, especially in the current market when interest rates are quite high, is the rental yield. So the rental yield is essentially calculated by dividing the annual rent a property expects to achieve by the purchase price. So in the current market, we want to get the rental yield. Well, most investors, because cash flow is such an issue, we want to get the rental yield as high as possible. So it's really important to make sure that the property you're buying does achieve an adequate rental yield. Now, rental yields vary from different property types. So house and land versus townhouse versus apartment. The rental yields on new builds compared to existing properties can differ as well. But I think for a new build house and land, probably a fair rental yield in the current market would be, anywhere between 4% and 5% is pretty good, particularly in Christchurch. Maybe in Auckland, you would expect them to be a little bit lower. For a townhouse, really, we'd only look at anything yielding between 4.5%. You were even getting townhouses yielding as far as sort of 5.5% on a long-term basis, which is really good. That was unheard of back in the day. And then for an apartment, I probably wouldn't be buying anything that yielded, say, less than 5.5%. Ideally, you'd want it to yield north of 6%. I think just because house and land packages or the yields on house and land packages and townhouses are actually catching up with that of apartments. So it is really important to look at the rental yield of the property you're purchasing and just make sure that it sort of does fit within those brackets. Because if it doesn't, then potentially it's not the right property for you. Obviously, some investors don't care so much about rental yield, especially ones that have sizable portfolios and they're chasing growth. But if you're a new investor, I think it is generally quite important to look at the rental yield.
Yeah, I think so, especially for a new investor. Obviously, if you're an experienced investor and you've got quite a large portfolio, you may have cash flow to a point where you can buy a few lower yielding properties, which may be in really good areas, and you might get better growth long term. But when you're starting out, a new investor really needs to get high cash flow properties, because that's the thing that will hold you back when it comes to buying a next one, is the lending from the bank, and it will be cash flow that will hold you back. So important to start right, and yields are important.
Yeah, I mean, let's say you purchase a $1 million property, for example. For simplicity's sake, if that property increases in value 10% over the course of a year, you make a 100K equity gain. It's incredibly hard to save that amount of money. And so cash flow is the thing, or the component that holds a lot of investors back from going again, rather than equity, because equity tends to build up relatively quickly over time. Whereas if you don't have the income to service your investment properties, especially as interest rates are high, it does become incredibly difficult to grow a sizable.
Yeah, especially at the moment, as I said, while interest rates are high. Really important to get good yielding properties, and capital gain with any of the properties that we're advertising. There's nothing really in areas that are going to have a really low capital gain. It'll either be, from anywhere to, from at least average to above average. And there's a lot of different factors we look at when selecting properties to make sure we outperform the average, even in areas that are currently performing average. We'll talk about that a bit later on.
Yeah, for sure. So this is just a quick example. I mean, you've got 3 properties here. One's a house and land package. The other 2 are townhouses. You'll notice that the rental yield, or the gross yield, for property 1 it's a house and land package that's super strong, 4.85%. I'd say traditionally that's probably a pretty good deal. I don't know what the purchase price is, but if we're just looking at the yield, that's probably a goer in my books. Property 2, if I'm chasing yield, this is a townhouse, 3.64%. Not great. In reality, as I said before, would expect that to be at least over 4%, ideally over 4.5%. My gut feeling is that this particular property, now I didn't create this slide, but it's likely a more expensive townhouse in a relatively good suburb, because generally speaking, would expect rental yields in better suburbs or more premium suburbs to be less of that than medium or lower tier suburbs. Property 3, 5.21%. it's a townhouse. That's a really good yield. It certainly would be worth considering that property if you're chasing yield. As we said before, a lot of investors chase the growth side of things, so yield might not be taken into consideration as much. I mean, property 2's probably just gut feeling likely to grow in value faster than that of the other two.
Yeah, I think that particular one is in a really good location, so probably would receive better capital growth. But so if you're chasing equity gain alone, then that would be a good option. But if you're starting out, it's a pretty low yield, so it's going to really affect your cash flow.
Yeah, that's pretty much it on yield. I mean, if you can maximize your rental yield, you're probably in good stead to grow your portfolio over time. Another factor worth considering when assessing whether or not a deal is good or bad is, I guess, what the property can be used for. Now, at the moment, as interest rates are a little bit higher, short-term accommodation or visitor accommodation has become much more prevalent, and investors are putting far more thought into short-term accommodation than they probably were prior to interest rates being as high as they are now. But when it comes to investing in property, or residential property in particular, you can either purchase a long-term rental, a short-term rental, or a property that can be used for both. Now, there are some councils around the country have restrictions in relation to what you can actually do with your property. And Andrew, you might like to touch on this a little bit more, but in essence, in some residential areas, short-term accommodation is restricted, right? So you need to be careful how you go about
that's right.
renting out your property.
In Christchurch, for example, in a standard residential location, there are restrictions around how many days you can actually Airbnb that property. And I think the maximum you can get at the moment, if you get a resource consent from the council, is probably about half the year. So you just need to be careful when buying properties, if you're going to short-term them, that they are in the right zoning. I mean, who knows how that's going to change in the future, but that's the way it is right at the moment. And yeah, I mean, I'm sure a lot of people are short-terming properties in areas they're not supposed to and probably get away with it. But we would recommend that if you're going to short-term it, you buy a property in the right zoning, which would be in Christchurch. Central City mixed use would be an example, where you can short-term a property 365 days a year. So just something to be aware of anyway when looking at the short-term thing, or which we'll discuss shortly. There are some properties that you can only short-term, which I'll talk about in a minute. Yeah,
so what we've outlined in the next few slides, we've got 3 properties. One property we think would be suited to a long-term rental, one that we think would be suited to a short-term rental, and one that could be potentially used as both. And I guess we'll give our reasons as to why we think they are best suited to, whatever usage they're going to be used for. So this is a listing we have just taken on yesterday, actually, 112 Wildberry Street. So this is in Woolston, Christchurch. Now, I think as far as its usage, this is certainly best suited to a long-term rental. The reason being is it's in a suburban area, so it's not in the city in Christchurch, and zoning rules also place restrictions around how it can be used as visitor accommodation. On top of that, it has a really good rental yield as a long-term rental, 5.1%, super good. I just don't know that visitor accommodation in Woolston would go as well as visitor accommodation in the central city, for example. The purchase price is solid as well, so it's $639 for a 3-bedroom, 2.5 bathroom townhouse in Christchurch. And because the purchase price is solid, the rental yield is subsequently really good. So this is a long-term opportunity, I think, certainly not short-term. And yeah, I think long-term is the way to go on this one.
Yeah, so here we've got this one here is a property in Wanaka. It's on the corner of Anderson and Albury Road. Really good location. This one it's a short-term rental only. It has a resource consent for a maximum of 90-day stay. So basically, this one here would be one of those ones that could only be short-termed. But probably when you look at it, it's in a holiday location and a very busy holiday location. So, it would be best suited to that sort of application anyway. And when you look at the rental yield for this property, it's really strong at 8.8%. So yeah, this one here would be an example of short-term only. It's in a very good location in Wanaka. You'd expect excellent capital growth there, and there's a real shortage of accommodation. We know we've sold another project very similar to this in Albert Town Riverside Residences recently, and they're all renting really well with really high occupancy and good rates. So we know this one will go well, but it's a short-term only. So if that's not what you're after, or you find that might be a bit risky for your situation or whatever, it may not be for you, but you know, it is a very good option and provides very good returns. So yeah, it's a short-term property.
And the point of talking about these particular properties is not to decide whether or not they're a good deal or a bad deal. I think they're all really good deals in their own right. But I guess the point is, you know, if you're an investor looking to invest in visitor accommodation, then Wildberry Street's probably not for you. And if you're looking to invest in long-term accommodation, then Anderson Road certainly isn't the right property for you either. But if you're on the fence, we still do have an option for you. And that is development we have in the city at 340 St. Asaph Street. Andrew, do you want to talk a little bit about it? So
basically this one here is in the zone I mentioned, Central City mixed use, which means it can be used for short-term and long-term accommodation. The good thing about this one is it's very close to the new stadium that's going to be built. At the moment, it's in a sort of what you call it a bit of an industrial area, but we think once the stadium is built, and we're already seeing a bit of this, there's quite a bit of residential starting to go in around here. And once the stadium's built, there'll be a lot of other hotels, restaurants, bars developing around this area. At the moment, it's really cheap. I think the developer will take 609 for the first couple of sales. So really cheap for a property in the city. And, you know, we think long-term potential is really good for this because of the zoning and the fact you got a stadium there, a whole lot of development happening around the area. And this is a gentrifying area, which we'll talk a bit more about in a minute, and an area that has great potential in the future because it's so close to the city and everything else as well, even the hospital. So really great location, probably slightly industrial at the moment, but set to change. And I guess the main point with this one is you can do both because it has the zoning to do both. So you could either short-term it or long-term it. So you've got options.
But it's also the right location to do both, right?
That's right. Yeah,
it's certainly visitor or demand in terms of visitor accommodation, but long-term tenant demand as well, zoning aside. So it is a really flexible opportunity we have on our books, which I think is cool. Another factor we take into account when assessing whether or not a deal is a good one or not is vendor incentives. Now, vendor incentives are becoming almost a thing of the past. Like they're still around, but they're certainly not as prevalent as they have been over the last couple of years. As the market has picked up since really the second half of last year, we've noticed vendor incentives have been less and less prevalent. And saying that, vendors still are offering them. Like they're still open to negotiate, open to offering discounts and that sort of thing. It's just not as easy as it probably once was.
Yeah, it's definitely tightened up, but there still are some good vendor incentives out there. I guess it's a matter of knowing who's offering them and, you know, being in the market to just understand exactly how they're happening.
Yeah.
But they can be really worthwhile for a number of reasons. So yeah, still out there, so talk to us.
Sure. But it's important to note, just because a deal might have an incentive attached to it doesn't necessarily mean it is a good deal. So some examples of vendor incentives could be cashbacks. So a cashback is essentially money paid to you by the developer on settlement. It ends up in your bank account. You actually see the money. So it's different to a direct discount in that aspect. I've seen some developers even offer furniture packages, holidays, or rental guarantees. One thing that's super important to check is that the incentive, if the developer is offering one, hasn't been priced into the purchase price. I can think of an example from probably a year or so ago where we had a property on the market and the purchaser wanted a discount. Now, this particular property had a rental guarantee attached to it. So essentially, the developer was guaranteeing the rent at $1,000 a week per se, just for simplicity's sake. When the rental appraisal, i.e. the market rent, was only $800 a week. So when this property settled, essentially the developer was going to have to top that rental amount up by $200 a week in order to satisfy the rental guarantee, i.e. pay the purchaser $200 a week. I think it was for 2 years. Now, the purchaser in question wanted to negotiate on price. So we went to the developer and said, hey, what can you do with the price? And they actually said to us, hey, if you take the rental guarantee out, we could drop the price a little bit. Now, as far as I'm concerned, that's not an incentive because they'd price that into the purchase price. So we sort of lost faith in the developer a little bit after that, just because it was a little bit cheeky. And the same goes with cashbacks and furniture packages. Like, while the developer might be offering you a $20,000 purchase furniture package, if the purchase price is 20K more than what it should be, then it's not a real incentive. You know, you'd just be better off to pay the lower price. So it is really important to check that it is a genuine incentive and not just to have, because we find a lot of them are just to have in order to get leads and ultimately sales in the door.
Especially with cashbacks, just make sure you're not overpaying then getting a cashback. Make sure you're paying a fair price and then you're getting a cashback as well.
Hang on, I can just see a couple of questions here. I'm just going to check them. They're all really good questions. So we've got a few questions there. I'm going to leave them until the end, just because I think they may take some time to answer. But thank you so much for the questions. So we'll go on to the next slide. So yeah, just be careful with vendor incentives. Like, as I said, just because a property has an incentive attached to it doesn't necessarily make it a good deal. It is important to do your due diligence, and you can do your due diligence by talking to a company like the Property Factory. There's the pitch. Major infrastructure projects. Oh, hang on, Andrew. Oh, gentrification. There we go.
Okay, we'll listen first. So one of the big ways we work out, one way to work out capital gain in an area or what's going to happen in the future is to look into the past and see what's happened in the past. But what we like to do is pick projects that are going to outperform the average. And the ways to do that is to buy in areas where things are happening, basically. So gentrification is one of these things. Basically, it can happen for a few different reasons. It can happen with infrastructure projects that come in first and then, housing and everything goes around it. Or it can occur where, you've got a really good suburb close and then an average one suburb away, and then slowly, things spread into that area and it becomes better, you get more new housing. So there's a few different ways that this can happen. We'll just talk about a few examples. One would be the new stadium in Christchurch. So basically, Western Asif Street, the project there that we talked about, you get a big new something like that happen in an area, then obviously the stadium comes first, and then obviously you get a whole lot of stuff happening around it. So you get a whole lot more pubs and restaurants and everything else, a whole lot more happening there. And then obviously you get residential stuff happening around the area. Things become more valuable because people want to live there. Land becomes more expensive. Housing becomes more expensive there because it's a more desirable area. So you're outperforming the average. Another thing to look at is even a shopping mall going into an area or a new shopping area, and then what that's going to do for an area. There's been a lot of new motorways built in New Zealand over the past probably five years or so, maybe a bit longer. And these will make a difference as well. So if you look at Transmission Gully in Wellington, and then what's happening up the Kapiti Coast from there, how much closer that is now to Wellington itself. And if you're buying along there, Christchurch's motorways are another one. So you've got the southern motorway to Rolleston. And if you look at Rolleston, we'll have a look in a minute. We've got a slide to show you what's happened out there. But it used to take quite a long time to get from Rolleston into town. Maybe I used to live out there, could have been 45 minutes or so. Now it's 20 minutes down the motorway. So obviously it opens up. When it only takes 20 minutes to get there, a whole lot more people are more interested in or open to the idea of living in Rolleston. And obviously prices are cheaper. So it's supply and demand. You've got a whole lot more people looking at the area. only a certain amount of properties, so prices rise, and then obviously you'll find that prices are going to go up more than the average. So we look at that sort of thing. The same thing happened in North Canterbury with the Northern Motorway. You got areas like Silverstream, Ravenswood, Pegasus that have really jumped up in price. An older example, but even the Auckland Harbour Bridge. I mean, you look, it was hard to get to the North Shore before that happened. And now with the Auckland Harbour Bridge in there, I know it's been there for a long time now. Look what's happened to the North Shore. It's like a massive city in itself now. So, and prices are, it's quite a desirable area to live, and prices will have risen a lot when that bridge went in. So it's a matter of buying properties in areas where things are going to happen, which helps you outperform the average pretty much. We'll just have a look at this slide. This is Rolleston. And I know there was a few other factors in Rolleston, earthquakes, etc. But if you look at what's happened recently as we go through, a lot of it's happened in the last 6 or so years. And that's a town on the edge of a city that's grown from a population of about 3,000 to, we're looking the other day, it was about 35,000 now. So when you've got that many people piling into an area, and all of a sudden it's, it takes half the distance to get into the city than it used to, then obviously you're going to see prices rising quite significantly in that area above the average capital gain. So things like that we're looking at. Another example would be Glen Innes in Auckland, where you've got a suburb, St Heliers, just over the hill, which would be one of the more expensive suburbs in Auckland. I think myself and Alex were just looking through some houses the other day randomly, and there was one there, 300 square metres, about an 800 square metre section for 12 million with an ocean view. And then over the hill, you've got a suburb, Glen Innes, which traditionally a very, like a low socio-economic area, a lot of state housing, but it's very close to St Heliers. And when people get priced out of St Heliers, they still want to be near that area because it's actually a good location, close to a lot of different things around Auckland. What do? Well, they have to push over the hill. So you start to see gentrification of an area where you've got a whole lot of state housing. In the end, a large, it was quite a big plan for that area, and a lot of state housing got bowled and a lot of new terraced housing went in. But it would have been, if you bought in that area, say 10 to 15 years ago, property prices were very cheap. Now you'd pay for a 3 or 4 bedroom terraced house, it'd be 1.5 to 2 million in that area. And it's still spreading towards, the edge of, or spreading through Glen Innes, but you can definitely see from the St Heliers side. And that's an example of gentrification where it's more population growth and people being priced out of other areas that have caused that to grow as opposed to infrastructure. So the housing sort of come first there, and then you've got other sort of infrastructure that goes in around it. But there's some examples anyway, and that's what we're looking at the Property Factory. We're always looking at, okay, which areas are traditionally good capital gain areas, and then which areas are we going to see grow in the future? So, if you've got an area that's like Rolleston, for example, that average capital growth, then if you look at what's happened to it, it's obviously going to well outperform the average, and the yields are good. So we can get good capital growth in areas where the yields are good, as long as we buy in locations where there's going to be development, basically. So, yeah, I think very important and something we look at closely at the Property Factory.
Yeah, you always want to be buying in an area that is poised for gentrification, because ultimately, if it's not, then growth rates are likely to be slower. And I guess what we've been talking about does tie in with the whole capital growth side of things. I mean, the whole point of investing in property is for that property to grow in value over time, to ultimately provide wealth. But I guess the factors that do fuel capital growth are A, population growth, and B, gentrification, which are the two main drivers of capital growth. So I think if a property is likely to grow both in size and infrastructure over time, then house prices generally will follow suit, and historically they have done. Another thing we can look at when looking at the potential future capital growth of an area of a property is to look at historical capital growth rates. So typically, when it comes to investment in general, historical growth is a good indicator of future growth. So if a suburb has performed relatively well over the last 20 years, it's more than likely to do so over the next 20 years. So we certainly take historical capital growth rates into account when assessing how much we think a suburb is going to perform over time. Of course, if there has been significant population growth in recent times and significant gentrification, then that growth rate going forward is likely to be a whole lot more than probably what it once previously was. And if there was once significant population growth and gentrification and that's tapered off, then generally speaking, we could expect growth rates to slow over a certain time period. But we certainly don't want to be investing in property. We don't want to be investing in property in areas that are decreasing in population and have next to nothing going on. Unfortunately, in New Zealand, there aren't a whole lot of places like that. We live in a great country, but there are some areas where population growth is significantly slow. Certainly the main centres tend to grow the fastest, but there are trade-offs that come with that as well, I guess. So yeah, growing areas are the ones we like, basically.
Yeah, that's right. So P is historical capital growth, and then on top of that, how do we do better than the average historical capital growth? And that's buy into developing areas pretty much where things are happening. So yeah, they're the key things for location. Yeah.
So that's really it in terms of factors we take into consideration when assessing a good deal. We can have a quick look at how to spot a bad deal, but essentially it's just the opposite about what we've spoken about today. So there's no point in going through the entire webinar again and just doing everything in reverse. Look, if a development is super overpriced or a property is super overpriced, it's probably not a good deal. And as we said, you can check if it's overpriced by getting a valuation done, looking at comparative sales or listings in the area and that sort of thing. Again, if the rental yields don't quite make sense, it's probably not the right property for you. And if there's basically next to no growth points for the area, then it's probably not worth looking at either.
So all those things. What else we got? I think another one really to consider with some of these deals, we have the salespeople come to us and they're talking to buyers out there, and they might say, "Oh, we found this property around the corner and it's cheaper," but it might be real cheap, and then often if something's too good to be true, it probably is. That would be the saying, and we may have even looked into this development ourselves, but not listed it because the developer may not have a track record. They're not well capitalized. They probably don't really know what they're doing. And this is the sort of one I talked about at the start, where you might actually put a deposit down on this property and then it never gets built. Or they might come back to you in 6 months' time and say, "Oh, the project's not financially viable. We're going to pull it as per our vendor conditions unless everyone pays another 50,000 or something like that." And that can happen. So, and then you're sort of stuck thinking, "Oh, do I pay another 50,000 or do I walk away and start again?" So that's something to consider as well. Just because something looks real cheap on Trade Me doesn't necessarily mean it is a good deal. So talk to us about it. Bring the property to us and say, "Hey, what do you think?" And we can have a look at it and just see. As I said, we're always looking at what the best deals are in the market, and if it really is a good deal, then that's fine. But just be careful with that, because definitely you see it happen out there quite a bit.
Yeah. And hey, we've had buyers come to us before with deals that they've sourced outside of our business, and we've looked at them and thought, actually, that is a really good deal.
Yeah, we have.
Buy it, and we get nothing out of it. So
so it happens both ways.
But it is, if something does seem really, really cheap, generally it potentially is too good to be true. And we saw that happen with quite a large developer in Auckland, actually. A lot of their developments were really cheap. One of our sales guys said, "I've got buyers for this project. I've got buyers for this project." Or this developer's projects, and I just always there was always a bad smell to it, I thought. And eventually, actually last year, they went into receivership. We never touched it, thank God. But yeah. But I mean, that's essentially it in terms of the webinar. Like, we've obviously spoken about how to spot a good deal and factors we take into consideration, as well as what makes potentially a bad deal. As Andrew and I have touched on, we have access to a whole heap of deals throughout the country. the deals you see on our website are really only the tip of the iceberg in terms of what we actually have access to sell. So if you want to learn more about good deals and bad deals, please do get in touch. We can even look at exploring some property options for you. Both of our contact details are here. Feel free to reach out to us. We can either speak to you directly, we can tee up a time to meet, or put you in touch with one of our team, and they'd be more than happy to help as well. So if you've got any questions, please do fire them through. We're more than happy to take the floor and answer some questions. I noticed there's already a few sitting there.
Cool. Oh, let's have a look. What have we got?
What we might do is just stop the share. That's fair, Jonathan. Yeah. I'm getting better at this, or we're getting better at this. So questions are here. First question is, do we offer mortgage support? Now, we don't have an in-house mortgage brokerage as such, but we do have a lot of good relationships with a lot of good mortgage brokers throughout the country. So we can certainly point you in the right direction. And a lot of the mortgage brokers we deal with are really clued up in the new build space as well, right?
Yeah, that's right. And it's important to deal with the right mortgage broker when you're buying off plan, because some brokers are really experienced in it and understand the process really well, which is important. And some brokers aren't. They haven't done it very much. And that can be the difference between getting the deal across the line and not sometimes. It's just getting the right broker for off the plan property.
Yeah,
I think.
Yeah, for sure.
Next one.
What is a residents association for, and what is the per annum or monthly cost? A residents association is essentially to keep everyone within the development. Just for context, generally a townhouse development will have a thing called a residents association. It's similar to a body corporate in the sense it's a set of rules and a set of levies that are drawn up basically to keep everybody in the development happy and to keep common areas and collective insurance policies and that sort of thing in order.
Yeah, basically. And I guess the important thing to note with the residents association is the property still has a fee simple title, which means you own the land underneath it. And often the cost associated with a residents association is quite a bit lower than a body corp, where you actually own a percentage of the whole site as opposed to the land under your unit. And that would be a stratum and freehold. So yeah, most townhouses now are set up with a residents association instead of a body corp, especially the smaller ones. And it would be paid generally per quarter. You would generally pay it, but anything advertised on our site would be a per annum figure, but you would generally pay it per quarter. Yeah, so that's pretty much it for that one. So my wife and I have looked at townhouses as an investment opportunity for a few years ago, and she can't get her head around the kitchen storage and space in a lot of developments. Or like, how can you get her to see the bigger picture that renters can adapt and survive in any space? I guess the big thing here is when you look at a rental property, you're not necessarily looking at would I live in it myself. You're looking at, is there a market for it, or is there a rental market for it? And a lot of people, are happy with that and like to live in a smaller space because there's less cleaning, there's less maintenance. They can get out and do things with their weekend instead of spending them cleaning and looking after things around the house or doing the gardening. So the big thing is looking at, okay, who's going to rent this, and is there a market for it? Not would I like it? Because everyone's different, and there's different people for every different property, and a lot of people are renting townhouses because they're easy to heat, that's low maintenance. They're happy with a smaller kitchen, and etc. So yeah, what do you think, Alex?
Yeah, it's funny you should ask. I caught up with a friend of mine in the weekend who recently purchased I think it was a 3-bedroom townhouse in a city fringe suburb in Christchurch. Now I don't know how much he paid for it exactly, but somebody said to him, he said, well, why did you purchase this, i.e. a townhouse with minimal outdoor areas, minimal storage, when you could have purchased something in the suburbs for the same price with a large backyard and a much larger floor plan. And he said, basically, the last thing I want to do on my weekends is worry about maintenance, worry about cleaning. I just want to enjoy my weekend. So tenants, and in particular younger people, don't want the hassle of having to look after a big space. And I guess so obviously they get into a townhouse, which has comparatively smaller space and subsequently less storage. But storage is the last thing a lot of renters and tenants think about, and even owner occupiers. It's certainly not the end of the world. There's certainly a trade-off. It just comes down to the occupants' preferences, really. And for a lot of young people, a lot of young professionals, a lot of renters, the last thing they worry about is storage, because in reality, a lot of them don't actually have a lot of stuff either. Yeah.
That's right.
Yeah. So that's that one. Rental guarantees or cashbacks better. Again, comes down to your preferences. My personal preference would probably be a cashback, just because
I'd go cashback, because it's rental guarantees can be false sometimes, or they can be guaranteed on low rents as well. With a cashback, you can do whatever you like with it, put in a bank account. If you're buying a short-term rental, you could buy furniture with it. If it's if you've got a shortfall in your repayments on your property, you can use that to top it up for a period of time, or you can use it for anything else you like. So I think a cashback would definitely be preferable.
The other thing,
money in your hand.
Yeah. The other thing about rental guarantees is often they'll just be guaranteed at the market rate, and the rental market's pretty steady at the moment. So chances are you buy an investment property, it's going to get rented out for whatever the rental appraisal said it was. And so while the developer's guaranteeing that rent, it's not actually costing them anything on a weekly, monthly, or annual basis. So cashback's definitely the way to go in that sense. Yeah.
Do developers accept a 0% or 5% deposit? As I said earlier, often once developers, not always, but often when developers have reached pre-sales, they've got their finance where, the financiers are requiring a 10% deposit to consider that a legitimate sale. They often will consider it. It's just a matter of knowing which developers will accept what and how their funding works and everything else. So it'd be a matter of talking to us about it. Do developers accept 0%? Sometimes. We've seen a couple of projects lately where the developer has accepted a 0% deposit. There'll often be, other requirements around it, like you have to prove that you can actually settle the property often, or they might look at what you own in case you don't settle. What can they, chase you for, etc. So, but some do, and we have seen it recently. Often a 0% deposit, the property may not be that well priced, so it may not be a great deal, but you don't have to put any money down. So the hope would be it goes up in value. It might be above market, but then the hope would be it goes up in value more during that time, than the extra you paid for at the start. So, but some developers do offer both of those. Yeah.
Do we negotiate on the buyer's behalf? Yep. So we do negotiate. Like a lot of our, pretty much all of our listings will be priced. Occasionally, buyers will offer slightly less than the asking price, and that's fine. It's just a case of getting the offer on paper and really starting that conversation with the developer. As we said earlier, developers are becoming less inclined to negotiate. Like they do have offers rolling in their door on a daily, weekly basis. But certainly on a lot of projects, there is still room there to negotiate. So how does that process work? Well, essentially, it would start by having a conversation with the salesperson or one of our investment sales specialists. Get that offer on paper. We always find getting the offer on paper is the best way to begin a negotiation, because if we call the developer and ask, hey, would you accept X price on X development? It's still hypothetical to them. It's not real. In fact, we've seen many instances where a developer said no to a price over the phone and then said yes as soon as it's on paper. And then, so we just go back and forth with the developer until we can find a mutually beneficial price, essentially. Hopefully everyone's happy at the end of the day.
Yeah, that's right. Another one here. Hi, are you located in Christchurch? And are you limited to locations or offering services to all over New Zealand? Also, how much do you charge, please? For a start, our service is free. So we get paid by the developer in the form of commission, and the service we offer to our buyers is a free service. We're located in Christchurch, but we can do we can meet with people anywhere via Zoom or phone call. And we have agents in Wellington and Auckland as well. So if you did want to, if you lived in Christchurch and you wanted to view a property, or if you were somewhere else anyway, and you were talking to someone in Christchurch, you could still view a property in Wellington with one of our agents, or Auckland or whatever. So yeah, we offer services all over New Zealand, and we sell all over New Zealand. At the moment, we've got projects in Auckland, Wellington, Christchurch, Central Otago. So the Wanaka, Queenstown, we've got some coming in Cromwell. We've also got projects in Dunedin. So we'll sell to anyone living anywhere, to anywhere in the country, pretty much. Yeah.
Next question. Now, we may have answered this a couple of questions ago. Are developers negotiable on deposit? Could I pay 5% given that the money sits in a trust account? I was just wondering if it was possible. Yep. Look, some developers are open to the whole 5% deposit side of things, especially developers that have met their funding requirements. Now, yes, the money does sit in a trust account, so the developer never sees it until settlement, but often their funder will require the full 10% to be sitting there just to show commitment from you as the purchaser that you do actually intend on settling the property. So whilst the developer doesn't see the money, it may not seem like it matters that you only pay 5%, for example, but in reality, it's not the developer that requires the money. It's generally their funder, just for their peace of mind.
Yeah, that's the funder, and they'll want it because they, as Alex said, they want to know that you've got enough capital there to actually settle the property. So yeah, but you can pay 5% in certain circumstances.
This next question, what would be your number one pick out of all of your stock that you have at the moment, and why? It's funny you should ask, because I was actually going to press Andrew on this at the end of the webinar, but I completely forgot to ask. So Andrew, what would be your number one pick out of all of our stock? And give us 3 sentences why.
3 sentences why.
I'll give you. Okay. I gave him 3. Okay. Yeah.
So my favourite project at the moment would be one on Harmon Street in Addington.
In Christchurch.
78, is it?
Yeah, 76, something like that.
The reason would be something I mentioned earlier. The 3 beds there are, I think, great value and a good 100k cheaper than some other product we've sold very close. The yields are really high, over 5% for a 3-bed unit with a garage, which is quite rare. Normally they yield lower. It's an excellent location close to Hagley Park, and it's an area that's gentrifying as well. So you've got capital gain tick, cash flow tick, and you're buying cheap tick. So that would be mine.
I can see a couple of cheeky questions coming through here. I don't know who they're from, but we'll get to those in a second. Where are we? He's answered that question. Yeah, Andrew's, as he said, Harmon, I think 340 St Asaph Street in Christchurch Central, just because $609,000 for a 2-bedroom townhouse right in the heart of town is about as good as it gets. And they've got covered parking. Car parking in the central city is quite rare in Christchurch, so covered parking is a huge plus, especially for 609k. That is a ripper deal, in my opinion. What have we got? What if I buy off the plans and the developer flops? Will our initial investment be returned? Yep. So really, if the developer flops, you don't forego anything other than potentially the opportunity cost of what you could have done with that money during the period in which it sat in the vendor's or the developer's solicitor's trust account. So as we said earlier, that money does sit in the developer's solicitor's trust account. They do not have access to that money. If anything goes wrong, the money or the deposit will be refunded in full into your account.
There was a lot of press today about Dunedin requiring more housing. How do you see this affect your current listings? Do you think the stadium being built in Christchurch will affect the demand on short-term accommodation in Dunedin? I don't really think so. I think there's probably still a lot of events that are going to happen in Dunedin. And there's a lot of other things happening in Dunedin as well as the stadium that would cause people to want to go there and use short-term accommodation. I mean, one would be the university. A lot of parents would be going to visit their kids there. So, that's a big market for short-term accommodation in Dunedin. And also you've got the hospital. You'd have, people going there for surgeries. You got people visiting some in the hospital. You got guest lecturers and doctors coming and everything else like that. So there's lots of reasons why short-term accommodation is good in Dunedin. And the stadium's one of them, which will still be there, even though there'll be one built in Christchurch. And I still think they'll still get events as well. And along with all the other reasons that I mentioned, why short-term accommodation is good in Dunedin, then why there's a lack of it.
Do we envisage getting more developments in Wanaka, Albertown area? Seems difficult given the restrictions the council places on developers. Of course, we're always looking for developments in Wanaka and Albertown, as well as the wider central Otago region. So we've got a couple of developments in the pipeline in Cromwell, which is super exciting. Obviously not quite Wanaka or Albertown, but very close to it. In fact, I'd argue that the growth opportunity in Cromwell's just about better than that of Wanaka at the moment, just because it's less established and there's lots of room for gentrification and infrastructure improvement going forward. But yeah, then there's not a whole lot of townhouse developments on the market, but we're certainly keeping an eye out for them all of the time. And I'd like to think that as they become more prevalent, or as they are released to market, over the next year or 2 or 3 years, we'll be keeping an eye out and we'll certainly jump on board.
We're always watching, as Alex said, but it is hard to get resource consents through the Queensland Lakes District Council. So they are slow. I mean, which is a good thing for people buying them in there, because it means not a whole lot come to market. I mean, I would check out the Anderson's Road one. There's a couple of units left there, and that's the last one at that sort of price we'll see in Wanaka for some time. Maybe we may never see anything like that priced that cheaply again. So look out for that one.
I feel like this question was from somebody on our team watching, but it says, are we related? And the answer is, as we established at the beginning of the webinar, no.
We're not related. We're not brothers, father and son.
What is the fee for working with the property factory? Again, we're paid by the vendor. Our service to you as the buyer is entirely complimentary.
Do you just sell the hugest commission property to me?
No.
No, we don't. And often our commissions are very similar throughout the projects that we sell, and they're fixed fee commissions as well. So no, we don't.
Occasionally on a really, really, really expensive property, like the commission will be a little bit higher, but generally speaking, nobody can afford the property anyway. So
yeah, pretty much. So no, what we don't is that commission is generally fixed fee. Why Harmon over Wildberry? Wildberry seems a lot cheaper. I just think it comes down to location. And
I also think Andrew had forgotten about Wildberry Street as well.
Well, that's a new project that's come up.
Yeah.
I think just comes down to location. Harmon's a bit bigger as well, larger, and just a bit of a better area of town. And you get higher rent in Harmon, but Wildberry's a great deal as well. It is a lot cheaper. But the yields are about the same when you look at them, because the rent's about lower in Wildberry, just given the area. So yeah, but they're both great deals.
In your opinion, what would be the best choice for first home buyers? Probably turn it into a future rental. Again, it comes down to your preferences and what you're looking for. If you've got a family per se, a new build house and land package on the periphery of a city could be a good option. Obviously, they make a really good family home, but they can provide an exceptional return going forward as well. So yeah, as I said, it comes down to your preferences, but I think, if you're looking to live in it and you've got a family, a house and land package is probably the way to go.
Yeah, and there's some great deals out there at the moment with house and land packages. So yeah.
Do you guys have a build quality control service as well? I'm assuming you mean, do we check the quality of the builds on settlement?
Yeah, I mean, we do check previous developments to make sure the quality is good, and we do pre-settlement inspections with the buyers prior to settling the property, so we make sure everything is looking as it should then. So yeah, I mean, we do check the developer's track record, and we also do the pre-settlement inspection to make sure there's no faults when you settle. So
we often recommend, we do recommend to our buyers that they get a building inspector through too, and we have a number, in order to do a building report, and essentially there's no defects with the property. And we have a number of relationships with builders that we can refer to essentially And can your next seminar be in the local office, and will there be wine? Have to check with the boss. Time will tell. If we can get more people here, we had a good turnout.
Yeah.
If we've had a good turnout this evening, if we can quadruple the numbers, we'll have it in the office, and there can be one. What's your pick for the North Island stock? As in, what's your pick for the North Island, or for houses in the North Island?
That's best stock.
Good question. I tell you what, there was that development we had listed on Tranent Road that was repriced today. I can't remember exactly what the price was. Was it 619 or something along those lines?
619. There's one in Tranent Road that's repriced today at 619. I think they originally sold for high sevens.
Yeah, so that is a development in Mangere in Auckland, but 619 is exceptional pricing for that location. That would probably be my pick of the bunch. In fact, we might look at getting that on our website, actually, because it is a really good deal. I think there's about 4 townhouses left in there, and they're completed as well, which is super good. Best development.
Same.
Best development. Yeah. Sorry about that. Yep. Okay, cool. Yeah, so the remaining units in Tranent Road have dropped in price to 619. That's a bloody good deal.
That is a great deal. As I said, they originally sold for a lot more than 649. So yeah, that is a very good deal.
Okay, last chance for questions. That looks like pretty much all of them. And Ricardo, he was the fella asking about Tranent Road. Now, if you'd like to learn more about Tranent Road, you'll notice it's not on our website. So please do get in touch with one of our team, because it is a really good deal. And there's certainly a lot of opportunity in that area and in that particular development. So reach out, either speak to the chatbot on our website or call one of our sales team off our website. You'll find the contact details there relatively easier. Or alternatively, our details were a couple of slides back as well. So that's basically it for tonight, team. Thank you so much for coming along. A really good turnout. As I said earlier, we're going to be doing these monthly. They'll most likely be towards the end of each month. We don't have dates for every month locked in yet, but keep an eye out. As I said at the start, if you have topic recommendations or ideas, flick them through as you think of them. We'd be more than happy to look into it. So thanks again for coming along. It's been wonderful to have you all, and we will see you in February.
Yeah, thanks everyone for attending, and we'll see you next time.